Hey everyone, welcome into another edition of Market Takes. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. I'm your host, Dion Rabouin, reporter at the Wall Street Journal. This is Market Takes. There's a lot going on out in the world, but we are going to tell you the three things you need to be watching for this week as you look to make sense of what's going on in the world. So, big thing, obviously, you've been hearing all about it in the news, seeing all the headlines. That's this debt ceiling debate. We're going to break down what's actually happening, make a little sense of all this hoopla that you're hearing out there in the news. We're going to talk through some important housing reports that are coming out this week. We're seeing some very significant movement in the housing market that I think bears watching out this week. And then we are going to get just a deluge of U.S. business conditions report from the Federal Reserve and from others this week that I think is really going to tell us some interesting things about the state of the economy. You're going to want to know what to watch out for there. Listen, let's just really quickly step back and talk about the debt ceiling. Let's separate truth from fiction and a little bit of all the, the blase blah that you've been hearing about in the headlines right now. So the debt ceiling, the important thing to keep in mind is we don't have to argue about this. Congress doesn't have to argue about this. This is a chosen battle. The debt ceiling has been raised 78 times since 1962, 49 of those under Republican presidents, 29 of those under Democratic presidents. It usually happens without a lot of back and forth. This year we've got a standoff and we've got this standstill, and we are having negotiations now. We are approaching June 1st, that June 1st X date that Treasury Secretary Janet Yellen has said when the Treasury will start to run out of funding and have to not pay some of its obligations. That's happened because we already essentially hit the debt ceiling number. We reached the $31.4 trillion debt limit back in late January, and the Treasury Department has already been taking extraordinary measures to keep the country from not paying some of its obligations. Now, important to talk about, you're hearing a lot of talk about defaulting, a default. That doesn't mean the U.S. isn't going to pay the interest on the money that it owes. It doesn't mean there's actually going to be a default on U.S. debt. Default, in the way that a lot of folks have been using that term, literally just means that some things might not get paid. Some Social Security beneficiaries might not get paid. Some Medicare beneficiaries, VA, veteran assistance, things like that, or Obamacare, things that the government is on the hook to pay for, that they are mandated to pay for, they might not make a payment on. The Treasury is going to prioritize paying the debt, because if the U.S. doesn't pay its debt, well, that could mean a debt default, which could mean a downgrade of the U.S. credit limit, which could mean that it costs significantly more for the U.S. to borrow, which would kind of raise the rates for borrowing across the board in the economy. That would be very bad. The Treasury is going to do everything in its power to avoid that, which means likely not paying back some of these other things rather than defaulting or having an actual default on the debt. So really quickly, let's take a look at the timeline. April 18th was tax day. We all know that because we had to get the taxes in. Secretary Yellen based her estimates of what the Treasury has to pay for things on what the tax receipts estimates were for that. Now, CBO and Treasury are still kind of counting some of these receipts, but we have an idea of how much money came in from taxes since that April 18th number. But no one outside of the Treasury Department actually knows how much money because, again, they haven't told us. This is really just an estimate. Now, the Congressional Budget Office, the CBO, has estimated, and they've said that receipts in April 2023 were 26% less than the amount recorded in the same month last year, which means based on the estimates they have, they actually got less in taxes than they expected and less than last year. Now, we've seen that was driven by a 36% decline in individual income taxes. CBO's projections show a federal budget deficit $100 billion more than estimated. Basically, they got less from taxes, largely from individuals, and now they're saying, okay, well, we've got less money to deal with, so we could be actually closer to that sort of default scenario, or not paying back certain, or not paying for certain obligations than that June 1st deadline even. So again, when we hit June, it's likely if we don't get a deal on this, some things are not going to be paid. You're not going to see a government shutdown like we saw back in 2011, but you could see some folks not getting money that's expected, some agencies not getting money that's expected. Congress is scheduled to be out for a state work period starting May 29th. So It may be if there's no deal today or tomorrow that because of the way the Senate and the House work, that they may not even be able to get, even if they agree to something passed before that June 1st deadline. And that could mean that some things don't get paid. Congress is supposed to be out from May 29th to June 5th. So that whole week, that's both the House and the Senate are supposed to be out. They're scheduled to be out. Obviously, they could just not take their state work period and stay in Congress and get a deal hammered out. June 15th is important because that's when you get quarterly tax payments due. A lot of that money from corporations and some money from individual taxpayers, businesses, business owners, things like that pay quarterly, so they'll get some more money. Expected to get a good chunk of change. So the Treasury has to sort of just make things happen between June 1st and June 15th when they'll get some more money rolling in. On June 30th, the Treasury is allowed to extract about $140 billion in borrowing power from a key federal retirement fund. So there's still money coming in. There's still going to be money coming in, but there's a lot of money going out, and no one quite knows how much it is, but we do know that we've got less than expected from taxes and less than expected from some of those payments that were expected to come in. Really, we are only likely to reach a default, as in the U.S. doesn't pay its debt obligations in August or September because of all those influxes and outflows of money. Before we get to August or September, there is money for things to be paid, but there is not enough money, and no one knows exactly how much money there is. Once we hit October, an actual default of multiple debt obligations become very likely. But again, we are in May right now. You've still got June, you've still got July, you've still got August, you've still got September before it is likely the U.S. just absolutely defaults on its bonds. However, the market is already responding, and we're not seeing much of a response in the stock market. And I'm going to show you right now really quickly. I want to put this up on your screen, what we're seeing in the market right now. And what you're seeing up there on your screen is the NASDAQ. And we have really seen the NASDAQ pick up. This chart you're seeing here is the year-to-date response of the NASDAQ. And you can see we're really starting to pick up. Stocks have really started to increase, and you're seeing prices rise, which shows you investors on the stock side really not that worried. But where we are seeing some worry is in the U.S. Treasury market, and not on these long-dated bonds. You're seeing here there are some worries about the debt ceiling deal not coming through, but if you look at the 30-year, pretty muted. You're seeing a 1 basis point move on the 10-year note, the most actively traded. But look down here on this 1-month note. Boom, look at that. Just a huge pickup, and that's because if there's no deal, the idea is that that June Treasury bond might not be paid, or that June Treasury bill may not get paid, and you were seeing folks sell that off up 15 basis points. We know when yields rise, prices fall. That means people are selling. They don't want it. They're trying to get out of that 1-month Treasury bill, and you are seeing a significant market reaction. I want to show you that year to date. And you really just see it pick up here. And you've seen that since about late April, early May, just a significant increase in the value or the yield on that 1-month Treasury bill. So that's just illustrating how the market is responding to this debt ceiling debate, and we are seeing a significant market response. So let's take a step back from this debt ceiling thing, because I know you probably heard all about that. Just wanted to inject a little reality in there. The housing market reports that we have seen. Last month's existing home sales report showed the largest annual price decline in 11 years. However, that was mostly in the expensive over $500,000 houses. Houses below $500,000, which is most houses on the existing home sales market, still seeing a lot of demand, still seeing prices rise. Want to throw another chart up here on your screen, and this is the new home sales report. And now what we're seeing there is an increase in the number of new homes sold. Last month, we saw the March report come in, and that was the highest number of new homes sold in a month in about a year, going back to April of 2022. Now, it looks like that September number is close, but it's not. You've seen actually the number of homes sold, of new homes sold in, the number of new homes sold in April was the highest since April of last year. So really a big increase in new homes sold, and that chart illustrates there the pickup we have seen in new homes sold. Will that continue? That's a big question that the Fed is going to want to know, that markets are going to want to know. And we are seeing an increase in supply, but we're not seeing prices falling. And in fact, new home sales, the median price was almost $450,000, up from $438,000 last month. So this week's new home sales report out on Tuesday will be very watched and very well followed. You want to check that out. We also get the pending home sales report on Thursday. That's going to be the latest detail on that. One chart I want to throw up here on your screen as well is this chart showing mortgage rates. And I want you to contrast what we've seen over the past, over the course of this year with mortgage rates, which have really risen a little bit, gone down a little bit, but they're largely right where they were at the beginning of the year, to that chart you saw with new home sales. New home sales have picked up significantly, even though mortgage rates have not declined, even though they're still around that high level that we saw in November of last year. And this chart just illustrates that even though mortgage rates have not declined very significantly, we have seen a defined and clear pickup in new home sales. That really just showing you that the housing market could be coming back, and that'll be important for the Federal Reserve. Last thing we want to talk about, business conditions reports. We get a number of reports out this week. We've already got the U.S. services and manufacturing reports. Those come out in Tuesday. Those are for May, and that's the latest update on business conditions in the U.S. You'll want to watch those because conditions have been deteriorating through a lot of surveys. We get the Richmond Fed survey on Tuesday. We get minutes from the Federal Reserve's last policy meeting on Wednesday. That's going to tell us a lot, and that could be market moving. We'll also get the Chicago Fed National Activity Index on Thursday, the Kansas City Fed survey on Thursday, and the Advanced Economic Indicators report on Friday. That's going to tell us a lot about the state of the economy, and you'll want to watch that. And listen, that's going to do it for us here on Market Takes. I'm your host, Dion Rabouin, reporter at the Wall Street Journal. Thank you so much for being with us, and I hope you'll be with us again next time.